Disclaimer.
Stop thinking of this as a market discussion, because what you're about to hear has nothing to do with price charts, technical indicators, or normal supply and demand. This is about power, and more importantly, control. For decades, Americans were told a simple story: that U.S. policy was neutral, that markets were free, that metals like silver were just commodities, that prices were discovered, not managed. That story is no longer true. And the most dangerous part is this: the shift didn't happen loudly. There was no announcement, no press conference, no vote. It happened quietly, the way all serious policy changes happen. Right now, silver sits in a place the system cannot tolerate, not because it's rare, not because it's shiny, but because silver threatens something much larger than any one market. It threatens credibility. And when credibility is at stake, neutrality disappears. Here is the uncomfortable reality most people are not prepared for. The U.S. government cannot remain neutral on silver anymore, even if it wanted to, because silver is no longer just a metal. It is a monetary signal, an industrial choke point, a strategic input, a barometer of trust in the system. And systems that rely on trust do not allow uncontrolled signals. That's where fear enters the equation. Not fear for investors, fear for policymakers. Because when silver moves freely, it sends messages they cannot spin about inflation, about currency credibility, about debt sustainability, about confidence in institutions. Silver doesn't need permission to speak. It reflects reality, and that is precisely why it becomes dangerous. This is the moment where neutrality breaks, not openly, but structurally. Policies don't need to say, "We control silver," to stop being neutral. They just need to prioritize certain users, ignore certain market signals, enforce selectively, remain silent where clarity would be expected. Silence is policy. Inaction is policy. And what you're watching right now is not incompetence or coincidence. It is deliberate ambiguity, because ambiguity buys time. Time to manage debt, time to protect institutions, time to prevent panic. But ambiguity also creates fear, because it tells you something is being contained. Here's the part most people won't admit. If silver were irrelevant, no one would care what it does. If silver were harmless, no one would need to manage perception. If silver were neutral, policy would remain neutral. The fact that neutrality is disappearing tells you exactly how serious the situation has become. And once a government stops being neutral toward a signal, that signal is no longer just information. It becomes a threat. This is not about conspiracy. It's about incentives. Governments protect systems. Silver exposes systems. Those two realities cannot coexist forever. That's why what comes next should make you uneasy. Because when policy quietly picks a side, history shows it never picks the public. Here is the mistake history shows people make every single time. They believe policy reacts to markets. It doesn't. Policy moves first. Markets adjust later. By the time the public realizes neutrality is gone, the decision has already been made. Quietly, deliberately, and permanently. This is not theory. This is historical pattern. Every major economic turning point followed the same sequence. First, signals become inconvenient. Then, policy becomes ambiguous. Then, access replaces price. Finally, the public is told this was inevitable. Silver is now entering that sequence, not because of panic, not because of ideology, but because the system no longer has the strength to tolerate an uncontrolled truth teller. When debt is manageable, governments can afford transparency. When confidence is solid, they can allow free signals. When buffers exist, neutrality is safe. None of those conditions exist today. The U.S. system is operating under extreme constraint, historic debt loads, rising interest costs, strategic industrial dependence, geopolitical pressure. In that environment, policy cannot afford surprises. Silver is a surprise generator. It reflects inflation before statistics admit it. It reflects scarcity before supply chains acknowledge it. It reflects trust erosion before narratives adjust. That is why neutrality ends here. Not with a ban, not with confiscation, not with an announcement, but with management. Management of perception, management of access, management of volatility. And the most dangerous part is this: managed systems feel stable right up until they don't. Because control delays feedback, and delayed feedback creates sudden failure. History shows this clearly. When signals are suppressed, distortions grow, imbalances deepen, corrections become violent. This is why moments like this are always misunderstood in real time. People assume nothing is happening because nothing dramatic is visible. But silence is not stability. Silence is preparation. Preparation for a system that knows it cannot allow certain outcomes to play out freely. This is the final warning. Once policy abandons neutrality toward a signal, that signal becomes strategic. And once a signal becomes strategic, access becomes political. That transition never reverses peacefully. It only ends in formal control, forced repricing, or structural reset. Which path is chosen depends on timing, confidence, and crisis. But the direction is already set. The decision to abandon neutrality has been made, not on paper, not in speeches, but in behavior. And history tells us that when behavior changes at the policy level, outcomes follow, whether the public is ready or not. That is the reality of power. That is the reality of silver. And that is why what happens next will not be accidental. Whenever policy stops being neutral, the same question matters more than any other. Who is being protected, and at whose expense? Because non-neutral systems always produce winners and losers. They just don't announce them. The first beneficiaries are always the same: large institutions, strategic industries, state-aligned actors. Banks benefit because volatility is contained. Industrial giants benefit because access is prioritized. The state benefits because confidence is preserved, at least temporarily. This is the logic of system preservation. When silver is prevented from becoming a free public signal, it protects debt markets from panic, currency narratives from challenge, industrial planning from price shocks. From a policy perspective, this looks like stability. But stability is never neutral. It is purchased. And the cost is paid by those without access, influence, or priority. The first to lose are always smaller participants. Small manufacturers face delayed deliveries, higher premiums, reduced availability. They cannot outbid strategic buyers. They cannot secure long-term contracts. They cannot absorb uncertainty indefinitely. Next come individual participants, retail buyers, independent investors, non-aligned actors. They are told the market is free, but they feel constraints anyway. Inventory disappears, spreads widen, rules become unpredictable. The system doesn't need to exclude them directly. It simply makes participation less viable over time. And then there's the most important group, the public. Because when silver is prevented from acting as a signal, the public loses information. They lose a way to measure purchasing power erosion, industrial stress, system fragility. This is not accidental. Public awareness is destabilizing when confidence is already thin. So neutrality gives way to managed perception. History is merciless on this point. Every time governments face high debt, strategic material dependence, fragile trust, they choose control over transparency. Not because they want to, because they feel they must. This is why outcomes always look similar across time and geography. The rhetoric changes, the tools modernize, the incentives remain, and the losers are always those furthest from power, not because they are targeted, but because they are expendable. This is the part that should make you uncomfortable. Because once policy abandons neutrality, it never returns to it voluntarily. Neutrality only exists when the system is strong enough to tolerate truth. Weak systems manage it, and managed systems always narrow options. Quietly at first, then permanently. When people imagine government intervention, they picture something obvious: bans, confiscation, price controls, emergency laws. That's outdated thinking. Modern policy does not need force to shape outcomes. It uses structure. And when policy is no longer neutral, it doesn't announce itself. It tilts the playing field until only one outcome is possible. Here are the tools. First, regulatory attention. Silver doesn't need to be restricted outright. It only needs to become inconvenient. Reporting requirements expand. Compliance scrutiny increases. Rules become clarified selectively. Nothing changes on paper, but participation thins. Smaller players step back. Liquidity quietly drains. Only large, institutionally aligned actors remain comfortable operating at scale. Second, priority allocation. When silver becomes strategically important, certain users are quietly prioritized. Defense contractors, energy infrastructure, large industrial buyers. This is never framed as favoritism. It's framed as national interest, supply assurance, or resilience planning. The result is the same. Silver still exists, but not for everyone, and not at the same terms. Third, strategic silence. This may be the most powerful tool of all. When policymakers stop discussing an issue publicly, it does not mean it is unimportant. It means it is sensitive. Silence prevents narratives from forming. Silence prevents price discovery from becoming a public conversation. Silence prevents silver from becoming a symbol, and symbols are dangerous. Gold is a symbol. Oil became a symbol. Silver cannot be allowed to become one again. Fourth, selective enforcement. Rules that exist for years suddenly begin to matter. Actions once tolerated become questionable. Interpretation tightens. This does not require new laws, only new priorities. And priorities are where neutrality dies. Fifth, incentive shaping. Capital is nudged away from open exposure and toward approved channels. Industrial hedging is encouraged. Speculation is discouraged. Long-term contracts are favored over spot markets. Again, nothing is banned. But the incentives change, and incentives drive behavior more effectively than force ever could. Taken together, these tools achieve something crucial. They prevent silver from becoming a public pressure point. No headlines, no panic, no referendum on confidence, just a quiet reordering of access. This is how policy manages risk without admitting it exists. And once these tools are in place, Neutrality is gone, even if the language never changes, because when the rules are applied differently depending on who you are and why you need silver, the market is no longer free. It is guided. This is the point where everything converges, because once you understand the U.S. debt position, the monetary structure, and the role silver plays inside both industry and psychology, one conclusion becomes unavoidable. A truly free silver market is incompatible with the current system. Not politically, not rhetorically, mathematically. The United States does not operate on savings anymore. It operates on confidence in debt. Debt that must be rolled, debt that must be financed, debt that must appear manageable. That appearance depends on three fragile pillars: low real interest rates, controlled inflation expectations, belief that alternatives are unnecessary. Silver threatens all three at once. When silver rises freely, it does not behave like a stock. It behaves like a referendum. It asks questions. Markets are not supposed to ask out loud, why does money buy less? Why do hard assets outperform paper promises? Why does physical demand diverge from official pricing? Those questions are lethal during periods of record debt issuance, because once confidence cracks, debt servicing costs explode, interest rates rise, funding costs spiral, policy options collapse. This is why silver is not just another commodity to policymakers. It is a confidence accelerant. Left unmanaged, it amplifies doubt faster than official messaging can suppress it. Now add the industrial layer. Silver is no longer optional to U.S. strategic goals. AI infrastructure depends on it. Energy transition depends on it. Defense electronics depend on it. That means allowing silver to price freely could increase costs across strategic industries. Slow deployment timelines, expose supply vulnerability. This creates a trap. If silver is allowed to rise, honestly, it signals monetary weakness. It raises industrial costs. If silver is suppressed, physical availability tightens. Industrial users feel pressure anyway. There is no neutral outcome. So policy chooses damage control, not by banning silver, not by confiscating it, not by openly fixing prices, but by ensuring the market never becomes a focal point for public awareness. This is why silver rarely receives clear policy discussion. Silence protects flexibility. And flexibility is everything when a system is stretched. History shows this pattern clearly. Whenever governments face high debt, strategic industrial dependence, fragile confidence, they intervene, not loudly but structurally. They influence flows, they shape incentives, they tolerate distortions. They prioritize stability over transparency. A free silver market would remove that buffer. It would force reality into the open. And systems built on confidence do not survive unfiltered reality. This is why neutrality ends here, not because silver is dangerous in itself, but because it reveals too much too quickly at a time when the system cannot absorb the truth. Silver has a problem that no policy framework is comfortable admitting. It refuses to stay in one category. Gold is easy for governments to understand. It is monetary. It is symbolic. It sits in vaults and moves slowly. Copper is easy to understand. It is industrial. It is consumed. It does not signal trust or distrust in the system. Silver is neither, and that is precisely why it becomes dangerous. Silver is both, a monetary signal and a critical industrial input. This dual nature makes it uncontrollable in ways policy planners deeply dislike. When silver rises because of industrial demand, it sends a monetary message. When it rises because of monetary stress, it disrupts industrial planning. Either way, it speaks. And when a signal speaks without permission, systems respond. This is the strategic problem silver creates for U.S. policy. If silver is allowed to trade freely and visibly, inflation narratives weaken, currency confidence erodes, debt sustainability is questioned. At the same time, if silver becomes scarce, AI expansion slows, energy transition costs rise, defense supply chains tighten. Those two pressures collide directly inside U.S. policy, and neutrality cannot survive that collision. Because neutrality would mean allowing silver to reveal inflation honestly, expose supply constraints publicly, force price discovery naturally. That outcome is unacceptable to a system that relies on managed perception. This is why silver is treated differently than other commodities, even when no one says so. Oil can spike, and policy intervenes openly. Rare earths can tighten, and policy frames it geopolitically. Semiconductors can shortage, and policy subsidizes production. Silver is different. Intervening openly would acknowledge its monetary role. Ignoring it completely would allow it to speak too loudly. So policy chooses a third path: containment through silence and selective pressure. This creates an illusion of neutrality while outcomes drift in a controlled direction. Silver's strategic problem is not that it is scarce. It's that it reveals truths at the wrong time. Truths about purchasing power, system stress, industrial vulnerability, trust erosion. And truth is dangerous when confidence is the primary currency. This is why silver cannot be treated like copper or aluminum, and it cannot be treated like gold either. It occupies a space where markets want transparency, policy wants opacity, That tension always ends the same way. Policy asserts itself, quietly. Not because of ideology, not because of malice, but because control systems cannot tolerate uncontrolled signals. This is the moment silver entered. And once a material becomes a signal of systemic truth, neutrality is no longer an option. It becomes an obstacle. This is where most people get it wrong. They expect power to announce itself. They expect policy shifts to arrive with headlines, legislation, or emergency speeches. That is not how modern control works. When a system is fragile, visibility is the enemy. So instead of declaring a change, policy redefines the environment quietly until the outcome is unavoidable and deniable at the same time. This is what a non-neutral policy looks like in practice. Nothing is banned, nothing is officially restricted, nothing is openly manipulated, yet outcomes change anyway. Silver doesn't need to be controlled directly for neutrality to end. All that's required is selective pressure. Pressure looks like silence when clarity would calm markets, enforcement when activity becomes inconvenient, regulatory attention that appears routine, priorities that favor certain users over others. This is not conspiracy. It's standard state behavior under stress, because governments don't manage markets, they manage confidence, and silver has become a confidence problem. When silver rises sharply, it undermines official inflation narratives. When silver shortages appear, it exposes supply fragility. When physical demand diverges from paper prices, it reveals leverage. None of those outcomes are acceptable during periods of record debt issuance, rising interest costs, geopolitical strain, industrial rearmament. So the response is subtle. Silver is allowed to exist, but not to speak loudly. And the most powerful tool here is ambiguity. Ambiguity allows policymakers to avoid accountability, prevent panic, deny intent. Ambiguity also creates fear, because it tells informed observers that something is being managed behind the curtain. Look at what's missing. Where are the clear statements about silver's role in national industrial strategy, energy transition planning, defense supply chains, monetary signaling? Silence here is not accidental. When a material is irrelevant, it is discussed openly. When it becomes sensitive, discussion disappears. This is the pattern. The moment silver became essential to AI infrastructure, energy systems, and advanced electronics, while simultaneously acting as a monetary signal, it entered a zone where open discussion becomes dangerous. So policy retreats into vagueness. Rules remain technically neutral. Enforcement becomes situational. Outcomes become directional. And the public is told nothing has changed. This is how neutrality dies in the modern era. Not with force, not with bans, not with declarations, but with environmental control. And the people who feel this first are not investors. They are industrial buyers facing allocation, manufacturers facing delays, procurement teams forced into long-term contracts, smaller players quietly pushed aside. By the time the public notices, the system has already adapted. This is why fear is the correct response. Not panic, but awareness. Because when policy stops being neutral, the rules you think you're playing by no longer apply equally. And the worst mistake at moments like this is assuming silence means safety. Silence means the decision has already been made. To understand why this moment is so dangerous, you have to understand what neutral policy actually meant and why it mattered. For most of modern history, U.S. policy toward precious metals followed a simple principle. Metals were allowed to exist as signals, not as threats. Gold and silver were treated as commodities, hedges, historical relics, non-essential markets. They were allowed to rise, allowed to fall, allowed to trade freely, as long as they did not interfere with the credibility of the broader system. That was neutrality. Neutrality meant the government did not need to intervene, guide, suppress, encourage, or defend. Markets spoke for themselves. Silver could rally, and it was dismissed as speculation. Silver could fall, and it was dismissed as irrelevance. Either way, it didn't matter, because silver was assumed to be non-systemic. That assumption is gone. Because neutrality only exists when a market does not threaten confidence, and confidence is the foundation of modern power. The dollar is not backed by metal, it is backed by trust. Trust that debt will be serviced. Trust that inflation is controlled. Trust that institutions are stable. Trust that alternatives are unnecessary. Silver quietly undermines that trust, not through ideology, but through math. When silver rises independently of official narratives, it raises questions policymakers cannot answer comfortably. Why is purchasing power falling? Why are hard assets outperforming? Why is industrial demand colliding with monetary demand? Why does physical availability diverge from official prices? These are not questions governments want the public asking during periods of high debt and fragile confidence. This is where neutrality historically ends, because once a market becomes a truth teller, it becomes inconvenient. And inconvenient signals are never left unmanaged for long. Historically, neutrality was possible because debt levels were lower, Industrial dependence was manageable. Alternative assets were niche. Monetary systems had buffers. Those buffers are gone. Debt is now systemic. Industrial dependence on silver is strategic. Alternative assets are visible. And buffers have been exhausted. In that environment, neutrality is no longer a luxury. It becomes a liability. That's why policy behavior changes before policy language does. The government does not need to announce a shift. It simply allows certain pressures to exist while suppressing others. It enforces selectively. It remains vague where clarity would fuel confidence loss. And the public mistake is assuming neutrality still exists, because no one said it ended. But neutrality doesn't end with speeches. It ends when the incentives change. And the incentives have changed. The moment silver became both a monetary signal and a strategic industrial input, it crossed into a category where neutrality historically does not survive. That is the quiet transition we are living through now, and it is never reversed.
Disclaimer.